All right. Good afternoon, everyone. Rich Swerbinski with the Mortgage Collaborative here once again with the Last Week in Mortgage Today, our weekly walk through all the latest news happenings with regards to the residential lending industry. Each week, I am pleased to be joined by one of our lender members as my co-host. And this week, once again, in the co-pilot seat, the president of Success Mortgage Partners out of Michigan, Allison Johnston. Allison, always great to see you.
You too.
Awesome. Let's go ahead and get right into it. And just a reminder to all our attendees, any questions, comments, thoughts, anything you have or want to add to the program, go ahead and pump it into the chat with the Q&A, and we will voice it aloud and incorporate it into the program. So Allison, as has been the case for a while now, so much going on in the mortgage industry. We were joking before we went live, just the constant change, switch of presidential administrations and regulatory view on a bunch of different things, and a lot to get into there. But a couple pieces of kind of breaking news. I just wanted to get your thoughts on. One is the Case-Shiller Home Price Index, kind of the bell cow of home value appreciation in America, just recently released record high year-over-year home appreciation, as in the history of this index, up 18.6% nationally, home values year after year. This jives with similar reports put out by FHFA recently. I think they had 18.8. NAR year over year, July up, sale price is up 17.8%. But essentially, the year of this last pandemic, we've seen home values go up in America about 18%. Kind of crazy.
Yep. Yeah, and there were some other cities like Phoenix was the leader, I think, for the 25th straight month, and they were up 29.3%. And then I think right behind them was San Diego at 27%, which is amazing. And then they had some other states like Boston, Charlotte, Cleveland, that also reported highs. Yep.
Normally you don't see Cleveland in any stories about, great home price appreciation, but somebody that bought a house a few months ago, I'll take it. But if you bought a house in Phoenix,
that's right.
That was crazy to me. 25 months in a row, Phoenix has been the highest appreciation event. I think they track like 20 or so major metropolitan markets, and kind of crazy. If you've got property in Phoenix, bully for you.
Yeah, really.
Another piece of news that just came out, kind of on the other end of the spectrum, and I think will be something we'll be talking about, unfortunately, on this show in the weeks and months and years to come, probably, is just regulatory clampdown. DOJ and Treasury teaming up to lobby I guess they reached a settlement with Cadence Bank out of Texas, $8.5 million penalty for redlining in the Houston area, essentially marketing to just white borrowers and not doing a proportionate amount of business. Nothing really to note here other than, it does jive. There was a report that the CFPB put out a couple months ago, probably more relevant to our listeners and all our members, just hinting that this was coming, hinting that they had found, after just a couple months of the new CFPB being in office, several cases of lenders that had violated the Truth in Lending Act, the Equal Credit Opportunity Act, talking about marketing faux pas as it relates to fair lending. So, as the president of an independent mortgage bank, it's got to be something that's on your radar, not regulated like a bank, really, maybe in the future a little bit, but something that's got your attention?
Oh, for sure. When Sandra Thompson took office, we really were watching the fair lending. And let's talk a little bit about that. So if people aren't doing regression analysis, they should be. We do them twice a year just to make sure that how we set our pricing is good and that we don't have any issues. Because I think with this administration, you're going to have to prove that you're not redlining. You're going to go through an audit, I'm sure. They're going to look at your HMDA data. They're going to look at your data on how you're pricing, and they're going to want to make sure you're not redlining. For us, we've always done a regression analysis, but we're going to do them more often. The other thing that we're starting to look at is where we're lending in our footprint. So it is very possible we might have to change some of our marketing efforts to make sure that we are marketing to maybe underserved areas where maybe we don't have an office, but maybe we need to start lending in those areas. Now, we probably won't be as regulated as heavy as a bank, but we could be still regulated to where we could have an issue with that. So we're just trying to be proactive. This administration is very big on fair lending, very big on redlining. So it's just important that everybody has their ducks in a row. Because what's going to happen is if you go into a CFPB audit and you don't have your ducks in a row, they're going to be in your office for weeks. So it's better to be proactive, because with the CFPB, if you can show that I'm marketing in these areas in Wayne County, I've done, I've opened an office here. We're trying to offer more programs. But, Rich, we were talking earlier, I have loans that I would normally run through the AUS approval through DU or LP, and I get an approval all day long. They have changed the engine. So if I have a borrower that maybe has a 680 FICO score, maybe wants to do 95% LTV, and maybe the DTI's tipping in the high threes, I can't get approval on some of those loans. It comes back refer. And the only thing that will say was it doesn't like the risk categories of this loan. The problem is, if I'm supposed to do certain types of loans, I have to get an AUS approval. So whatever tweaking they did to the engine, if they really want this affordable housing, if they want more people to get home ownership, they're going to have to change the engine to allow for that to happen. And right now we're seeing loans that we would be able to do all day long that now we're not getting an approval with either engine, DU or LP.
Really is fascinating. And some breaking news. Sandra Thompson just agreed to speak at our conference coming up here in 3 weeks. So we're gonna have a couple members, I think.
Great.
Lead like almost like a town hall where members are gonna be able to ask her questions. So really looking forward to that. And especially because you hit the nail on the head. What a weird dynamic we have going on right now. We've got a head of FHFA and a presidential administration and HUD Secretary Marcia Fudge that they are just banging the fair lending, level the playing field drum hard. And I think it's a great thing. But in the backdrop, you've got what you just said. We are hearing this from our members all the time, that LP and DU have gotten tighter. So the products that help the underserved, the low income census tracts, the minority census tracts, it's getting harder to get those borrowers approved. Also, you have FHFA now putting out there for comment, a proposal to raise Fannie and Freddie's goals in low income, very low income, minority census tracts. But there's no affordable housing out there to be bought. I mean, institutional investors are gobbling up these properties. So just a very weird dynamic right now. On top of this, you've got the regulatory heat getting ratcheted up. So it's
like, why aren't you lending? Well, because I can't get the AUS approval, and people can't find houses, and heaven forbid you're trying to get an appraisal in 3 weeks and you can't get an appraisal done. And we're seeing less property inspection waivers. It's an interesting dynamic, because I think the FHFA really does want to make a difference, but they're not talking to the AUS engine or the people that they need to, so that we can, write the loans. The problem is, let's say I deny a loan, and we have a second look process. So if people don't have a second look process, they should, because auditors will look for that. But I have to explain, I can't get it approved throughout your engine. I have to deny the loan. And I've finagled with these loans over and over again. Okay, what if I credit score increase them, right? But if you're a what if simulator, what if they put more money down? What if they try to I still can't get some of these loans through the engine for whatever reason. And it's frustrating to us, because we're trying to explain to the client, I can't get you approved. And there really is no manual underwrite for conventional loans. Now, maybe I could give them an FHA loan or something, but sometimes a conventional loan might be better for the borrower. So it's just tough. tough market too. And what houses are going for nowadays too is really tough. I mean, going for well over ask price, right? From the listing price, and then trying to get an appraisal in timely. It does add for some difficulties.
Yeah, I mean, I remember talking with you about this and others, like, 8, 9, 10 months ago, we were seeing just the slowdown, stoppage almost completely of new construction in America, largely because of the lumber and other supply issues. This is to a housing market in America that's already underbuilt, that is in desperate need of inventory. Kind of wondering aloud what things were going to look like a year from now with no solution whatsoever out there for the inventory issues in the industry, especially at the lower end. You've had nothing but institutional investors and private buyers have done nothing but ratchet up their investments in houses, gobbling these things up to either rent them out themselves or resell them for a profit. So it is going to be fascinating to see how this all plays out. And and then just the inherent kind of conflicts that we have in place where you've got administration speak and actual business application that are kind of conflicting with one another.
Yeah, and even in the new construction is hard because, right, there's no vacant land really. The lumber costs and then labor costs. People can't get, people to work on building new construction homes. That's the other thing that's a problem as well. So it'll be interesting to see what shakes out, especially in this type of market. I mean, I think with it being a seller's market and people getting well over their ask price, it does kick a lot of people out from trying to purchase a home, just because it just keeps raising.
Yeah, I'm not a big government guy, but I am at this point just pleading for, I think, government intervention to the inventory, new build, affordable housing parts of our industry in general, institutional investors buying up all these lower priced homes. There's things relatively easily, I think, that could be done, limiting maybe the tax advantages or eliminating them in some cases for institutional investors that are buying homes in certain areas or under a certain dollar amount, maybe incenting non-institutional investors that own investment properties to sell those properties now, maybe some sort of capital gains tax reduction or elimination.
Sure.
I think without government intervention to the housing inventory, especially the affordable housing inventory problem in America, you're going to have the Biden administration and Marcia Fudge and Sandra Thompson charging full bore ahead with these initiatives that are very important to them and important to America for that matter. But with a system that cannot support what they want to do and massive confusion to people that run mortgage companies like yourself that are trying to make sense of all this.
Yeah, it does complicate things. Not only that, but just the demand. Like I talked a little bit about the appraisals, and that is a real issue. If you have a 30-day purchase agreement, because right now, no seller is accepting anything over a 30-day. Can't do a 45-day, they won't take it. And you're taking 3 or 4 weeks to get an appraisal. A lot of times in these areas, we're blowing the purchase agreement and the seller doesn't care because they can turn around and sell their house for more money. Rich, you and I were talking and I was telling you about the situation that I had with an appraiser in Texas. I needed an appraisal back in 2.5 weeks. We were already up to paying $1,600 for an appraisal, $450 appraisal typically. We were willing to pay $1,600 that we were going to eat the cost. We weren't passing it on to the client, but he said $1,600 won't even turn his head. We're like, what about $1,700? Like, it's ridiculous. And sometimes when we pay the rush fee to the appraiser, and I understand they're busy, we still don't get it back in time. The other issue is the down payment assistance programs that are housed by the state. They're so far behind. I mean, I have some housing authorities that are 3 weeks to even review the file. There's no way I'm going to close on a 30-day. And so you just keep trying to get extensions, and then the borrower gets upset because you can't close on time. Then the seller relists the house, then you get a complaint, right? That now you have to respond to, and some of those things are completely out of our control. I mean, I'd love to be able to call the appraiser and say, I have to have it by this day, but they're 1099. I mean, they're self-employed. It's very difficult. I think we're just in a weird time right now.
And a good point dropped in the chat. Builders have slowed down because their ability to borrow has been restricted. Spec lenders are down and have been down since the crash. Lumber and labor are relatively new problems. That's a great point. I just know, having worked for banks that did a lot of construction lending, heavily regulated, the amount of capital that you have to hold against those loans, the way that they're looked at on the balance sheet, the interest rate risk, the liquidity risk, for doing loans, it essentially is not an amortizing loan for 6, 7, 8, 10, 12 months. So the banks, from a regulatory standpoint, are also limited. That plays into the commenter's point about the overall underbuilding of America and, the lack of new construction products and limitations to builders. So crazy. So, and then, your good point also on the down payment assistant programs and backlog there. And, it hasn't gone through yet, but the long bandied about infrastructure bill, it's been bouncing around Congress. Down payment assistance, part of that, got put in there somewhere along the line. Somebody finally figured it out and wrote a story about it a week ago. And I just sit there and wonder. I hear from you and others that the DPA administrators in the states are already way behind. One, two,
They are.
does down payment assistance programs right now, does it almost fuel a fire of, this issue of these lower priced homes and what they're going for, and some would say unhealthy appreciation of them? It's just a lot to kind of digest and think about.
I think in that plan, that $3.5 trillion, I think there is like a proposal of $100 billion going to down payment assistance. I think it was Maxine Waters that maybe brought that up. The problem is, if we're going to do, and they're going to put more into down payment assistance, they just need to hire appropriately so that, lenders can offer that program, right, and be able to get the borrowers to the table on time. I did we see housing loans stay on the warehouse line for up to 120 days. That's true. We see on the front end quite a bit to have them underwrite the file, because that's a requirement. So that takes about 3 weeks. But then to Mike's point, they sit on the line for months. They maybe fund once a week, but you're in a queue and they don't push your file up. Even if you have a situation to where somebody's going to be homeless, we've called them and said, can you please just look at the file? It's been in line for 3 weeks. They do not budge. It's kind of like being at the Secretary of State and you just need one thing, but you got to wait your turn in line. It's very similar to that, but it does cause for some complications, because then you're going to have situations where sellers of homes are not going to want to accept that program. They're going to want conventional FHA, VA, and VA still is a push that we have to do with some, real estate agents to accept it, and some sellers. But it is tough, because all you want to do is be able to lend to borrowers that, deserve a mortgage, and they should. And until they make those changes with the AUF engine, until we make some changes in appraisal land, trying to get appraisals in sooner, until we can make some changes with what's happening at the down payment assistance programs, it's very difficult to be able to finance certain borrowers.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week joined by Success Mortgage Partners President Allison Johnston. Allison, there's a report that came out a week or so ago just about private MI, PMI, kind of taking business and market share from FHA and other government programs. You talked about the AUS's DUNLP on conventional loans, the box kind of tightening a little bit. We had Jody Hall on last week as co-host. She spoke a little bit to which she kind of corroborated that report, saying they were doing more conventional than Govy too, that she'd seen the Govy box tighten a little bit. Have you guys been seeing that as well at Success?
Yep. Yeah, it seems like it's harder to get a loan done nowadays through the AUS engine as well. And even on FHA too. The other thing that's a little odd that we're seeing is C5 appraisals, which you really can't lend on because some of these homes are in such need of repair. Maybe you can do a 203K on it, but it's difficult sometimes to get contractors out to come and do work. So although a seller's like, well, I'm going to sell it as is, I can't get a contractor out to come and do the work. But depending on how the appraisal ranks it, you may or may not be able to lend on that unless you're going to do a 203K or some type of rehab program.
We talked earlier about the Case-Shiller Home Price Index, home values nationally up 18.6% year over year, a record high. That said, these last couple months, we've seen prices stabilize. There's been some reports on listing prices dropping on a good chunk, 5, 10, 15%, depending on the market of listings. Interest rates are still incredibly low. Federal Reserve Chairman Powell stuck to the script really last week, remaining steadfast on his commitment to keep rates low until he sees a lot more evidence that the economy is kind of turning around the corner, help mortgage rates, help mortgage bonds. That said, recent poll that Reuters put out basically said, housing affordability, even with low rates, even with listing prices and prices in general stabilizing or in some cases dropping, that housing affordability is going to continue to rise in the coming months and at a much more protracted basis on, once again, the lower priced homes in America. I know you guys lend nationally. You're headquartered in Michigan. I'm sure it's a lot like Ohio. I mean, if you want to get normally you could get a home for a family in Ohio, Northeast Ohio, for old school, $150,000, $200,000. Like, you can't get homes in that price value right now. It's insane what's going on with that price value, that starter home.
Yep. And it's going to really start impacting first-time home buyers. They're not going to be able to get that starter home. Those houses are being picked up by investors. And as you said, they're either being rented or they're sold for a higher price. But even in the $200,000 to $250,000 range, those are still getting 9 offers. They're still getting, $35,000 over ask price, which just keeps pushing that market up. It is interesting, though, to see some of the purchase agreements where they've started at, and then after the negotiation, $35,000, $40,000, and then, seeing where the appraisal comes in. So it's been interesting. So we'll see what happens, but I think that's going to be the case for a while.
In general, like you talked about appraisals, just the fervor over and, negotiating essentially to get them done. Like in general, any trends or momentum with, where appraisals are coming in relative to purchase price, just, from spring through now as we get towards the end of summer?
We don't have too many appraisal issues on value. What we have issues on with the appraiser is getting the appraisal back, trying to follow. I mean, literally, if you say you're going to have it back today, we're calling them at 3 o'clock and the appraisers are like, don't call me. We're like, but it's due today. We've had some that haven't hit value, and we've had some that have hit C5, but it's not a huge issue. But I'm not sure if because they're trying to get in a bidding war and they're listing it a little bit low to see, because when I recently just bought a house, and some of the things that I'm seeing that went on even when I went to buy my house was highest and best by this time at 4 o'clock. And I think there were 8 or 9 offers on the house that I was looking at. So it is a little crazy, highest and best. So everybody's putting their offer in, and I overpaid for a house because it was the house that I wanted.
This is the last week in mortgage today. I'm Rich Swerbinski with the Mortgage Collaborative and have just a few minutes left with Success Mortgage Partners President Allison Johnston. Allison, the general business climate in general, obviously switching the refis, it seems like are kind of saturating. There's still some refinance opportunity out there, but it's with TMC benchmark, we've seen, I think, like 8 months in a row now, the share of closings that are purchases go up. Margins, we're hearing from our members, are starting to squeeze. I think we were talking like 3-4 months ago, like, they're squeezing a little bit, but not as much as I thought. they would by this point. Now I think we're starting to hear and feel the squeeze a little bit there. And it feels like just the general like recruiting and business development part of our industry was, it was pretty much on hold for a year. I don't want to say totally. People were looking to hire ops people out throughout the pandemic, obviously, but
For sure.
salespeople, it was tough to leave those mega pipelines that everybody carried. With just, your classification of the general business climate now as we get set to head into the month of September.
We are still seeing some movement with ops people. We are still seeing some underwriters getting some very high salaries, but we are seeing more loan officers start moving. Last year, as you said, it was very difficult. Their pipelines were full. They weren't sure if they were going to get paid out their commission, but we have seen some more movement. We've also seen some crazy signing bonuses, which we're not a huge believer on, but we've seen some high, signing bonuses for loan officers where like, doesn't work out, call us back. So, it's been a little crazy with some of the things that we have definitely seen.
And not surprising, right? I mean, mortgage lenders made a lot of money these last 18 months, just sitting in like collab labs with our members. And, big discussion amongst like business owners is how to really like deploy, some of the profit and revenue from, to best set your company up for the future. And people are all over the board. Some are investing in infrastructure and technology, and, and some are just like
Technology.
And some are like, I'm just going to go buy some LOs. I was never that, have that strategy when I was a lender, but, there's a lot of mortgage lenders out there looking to grow of varying, skill levels and financial backing. So it doesn't surprise me that we're seeing the checkbook get cracked out here as things have normalized.
I mean, I've heard like a million. Like I've heard some crazy amounts. So we're like, wow. But I like your comment. I'm going to go buy some loan officers.
Yeah.
It's true. It's true. I mean, when we look at our growth model, and what we did last year, and last year was painful for us along with everybody else, just really technology. And, we're involved in the tech fund with the TMC. And I think that's really the way that, we have the ability to scale, because hiring 235 people last year was too hard. So if I can pick up through technology, it's going to make it easier, especially for us to recruit.
Great point. And yeah, our tech fund, it's not something we like push on the members. I don't want people to think I'm like selling the tech fund because, we're not profiting off of it. But it is a cool thing. I mean, success and Owen, he's been heavily involved, and it's pretty cool. We are getting a chance, the group of limited partners that have bought in, to really take a look under the hood at the things that are coming down the pike. And it's been a huge advantage strategically and from a business standpoint. I truly believe that for your company and some others that have been involved, because you're right. You can't like paying loan originators huge fat bonuses. That's not a winning strategy. Long term, I'd argue, even in the short term, it's probably not a winning strategy. And that the true way to boost efficiency and profitability and the market share is to be able to get loans closed quicker and cheaper, which will ultimately and always rule the roost, right?
Yep. And just putting money into technology to make sure you're as efficient as possible, and it'll pay off in the long run, because you'll need less people to do, those operational tasks. And when there's something that you've created a bot or maybe an efficiency for, the nice thing is it's done every single time correctly. So if we look at where we're going to scale in a couple of years, we know that we can keep everybody that we have, our 805 people, but then I don't have to go out and hire another 200 people. I can make the 805 people that we have under our umbrella more efficient and more accurate.
You guys have 805 employees now.
Yeah.
I remember we first met, I think you came to our Tucson conference probably 5 years ago now. And you guys were like 700 million a year, nice sized IMB, looking to grow. It's been really, really cool watching all the success, no pun intended, and growth you guys have had, your role in it, and really greatly appreciate what an engaged member you guys have been, and for once again joining me as the co-host this week.
Thanks so much. I really appreciate it.
And to all of our viewers / listeners, thanks for taking some time out. We are here the same time every week, 2 p.m. Eastern on Tuesdays for the last week in Mortgage Today. And until next week, have a great rest of the week, everyone. And thanks again, Allison.
Thank you. Thanks
All
so
right.
much. Have a great day, everyone.
Take care.